Today, AI tide lifts all boats, including the leaky ones. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. This is our weekly market update where we start in the US, across to Europe and Asia, and then in Australia, covering commodities and crypto along the way. As I mentioned last week, I regard these posts as perhaps the most important I make, even if not the most popular. But I was gratified by the positive feedback from you about them after last week's show. Please like and share. Stocks are still reaching for the stars, as this week's MSCI Global Index shows, by edging higher on Friday after registering a record close in the prior session, while US Treasury yields rebounded after sliding the day before when expectations climbed for US rate cuts. The S&P 500 notched a two-week winning streak, despite slipping slightly on Friday, closing about 0.1% lower after hitting a fresh intraday record, weighed down by fresh data showing consumers continue to worry about the economy. But the NASDAQ rose 2% across the week as Oracle joined the AI melt-up. The Dow Jones Industrial Average fell 0.6%. The European STOXX 600 was up another 1% across the week, though slightly weaker at the close on Friday, while the ASX 200 rose 0.7% to 8,864.9 at the closing bell, with 10 of the 11 sectors in the green. It was a heavy data week in the US, with inflation and jobs data showing on one hand a significant slide in momentum in the jobs market as more revisions landed, while inflation was a little more stubborn, again showing the potential contention between the Fed's dual mandates on jobs and stable prices. That said, these data releases did little to alter expectations that the Fed will still cut interest rates at its September 16th to 17th meeting, despite the whiff of stagflation that is in the wind, as the University of Michigan Consumer Sentiment Index, which tends to be negatively correlated with inflation, fell to 55.4 in September from 58.2 last month, missing expectations. And their survey of preliminary expectations for one-year inflation was unchanged from prior month's readings of 4.8%, but inflation expectations over the next 5 years climbed to 3.9% from 3.5%. Data on Thursday showed US consumer prices rose slightly above expectations and the sharpest monthly increase since January, while weekly jobless claims jumped to 263,000. That's the highest level since 2021, underscoring signs of softening in the labour market after last week's weak non-farm payroll report. The US economy likely created 911,000 fewer jobs in the 12 months through to March than previously estimated, according to what the US Labour Department said on Tuesday. Inflation was a touch higher than expected, and tariffs are likely to keep it elevated over coming months. But the weakening of the jobs market is now the Fed's priority, with rising jobless claims hinting at a pickup in layoffs at a time when hiring is subdued, ING analysts said in a note. An expected resumption of Federal Reserve interest rate cuts, an ongoing surge in enthusiasm around AI have helped to underpin equity market gains, but further deterioration in the US labour market could still challenge the rally. That's according to analysts at Barclays. Treasury yields rebounded from a recent dip, with yields on the 10-year Treasury up about 6 basis points to 4.068%, while the 30-year bond yield rose 2.9 basis points to 4.684%. The 2-year note yield, which typically moves in step with interest rate expectations for the Federal Reserve, rose to 3.562%. The rise in yields comes even as markets have almost fully priced in that rate cut next week. Global equity funds registered their first weekly outflow in 5 weeks through to September the 10th, as investors locked in profits and trimmed their risk exposure. Investors withdrew a net $3.06 billion from global equity funds in the first week of net sales since August the 6th. Outflows were driven by a net $10.44 billion in sales of US equity funds, the most in 5 weeks. European and Asian funds drew net inflows of $3.77 billion and $1.87 billion, respectively. In the corporate sector, Adobe Systems is in the spotlight after the maker of the popular editing platforms like Photoshop and Premiere Pro raises annual financial forecasts, citing solid demand for its AI-enhanced design software tools. 6 of the 7 mega-cap technology stocks advanced, although Amazon closed lower. Tesla jumped 7.4% after board chair Robin Denholm dismissed concerns that CEO Elon Musk's political activity had hurt sales at the electric vehicle maker and said the billionaire was, quote, front and center of the company after several months at the White House. With Friday's surge, Tesla shares remains down 2% across 2025. Oracle leaped 43% on Wednesday after the company unveiled 4 multi-billion-dollar contracts on Tuesday amid an industry-wide shift led by companies such as OpenAI and xAI to aggressively spend to secure the massive computing capacity needed to stay ahead in the AI race. It came back a little bit on Friday to $292.18. Warner Brothers Discovery jumped 70%, extending a surge from Wednesday when a source said Paramount Skydance was preparing a bid for the struggling media company. Shares of vaccine makers fell after a report said US health officials are planning to link coronavirus vaccines to the death of 25 children. Moderna declined 7.4%, while Pfizer and Novavax both lost more than 3%. Elsewhere, Supermicro, the AI tech firm, announced that it has begun volume shipping its NVIDIA Blackwell Ultra solutions to customers worldwide. Microsoft and OpenAI said on Thursday evening that they had reached a non-binding agreement over the AI startup's plan to transition to a for-profit organization. Microsoft gained 1.8% after the technology giant avoided a possible hefty EU antitrust fine by offering customers reduced prices for Office products, excluding Teams. For the week, the S&P 500 gained 1.59%, the NASDAQ rose 2.03%, and the Dow climbed 0.95%. In currencies, the US dollar rose on Friday, a day after falling on a surge in US jobless claims and modest inflation as investors prepared for interest rate cuts after a roughly 9-month hiatus. Dollar index, which measures the greenback against a basket of currencies, including the yen and the euro, rose just a little. Against the Japanese yen, the dollar strengthened 0.26% to 147.67. US and Japanese finance ministers on Friday released a statement reaffirming that neither country would target currency levels in their policies. The euro was up just a little to 1.1736 after on Thursday the European Central Bank kept rates unchanged and signalled that it was in a good place on policy. Britain's economy recorded 0 monthly growth in July, though, in line with forecasts, but did show a sharp drop in factory output, weighing on sterling, which weakened just a little to 1.356. In energy markets, oil prices settled higher after a Ukrainian drone attack suspended loadings from the largest point in western Russia, but gains were capped by concerns about US demand. US crude settled up 0.51% to $62.60 a barrel, and Brent ended at $66.88 per barrel. The markets are watching for sanctions or tariffs from the Trump administration aimed at reducing the use of Russian crude by India and China. India is the biggest buyer of Russian seaborne oil, mostly shipped on tankers that are under sanctions by the European Union, the United States, and Britain. Meanwhile, the International Energy Agency said on Thursday that global oil supply would rise more rapidly than expected this year because of planned output increases by the OPEC Plus group. In precious metals, gold was showing its 4th weekly gain in a row and trading near its Tuesday's record high as investors looked ahead to those US rate cuts. It was last at $3,680.70. European stocks closed in a mixed fashion on Friday, consolidating following a generally positive week as investors adjusted regional inflation and growth data. The DAX index in Germany and the CAC 40 in France were flat, while the FTSE 100 in the UK fell 0.2%, but all three were higher across the week, with the French CAC 40 about 2% higher, recovering amid political turmoil. The UK economy showed signs of a summer slowdown as July gross domestic product came in flat, with growth stagnating following a relatively robust first half of 2025, during which the British economy expanded by 0.7% of the first quarter and 0.3% in the second. Spot the trend. According to data released on Friday by the Office of National Statistics, the economy registered no growth in July, easing from the 0.4% expansion recorded in June. Bank of England policymaker Catherine Mann warned that UK inflation is projected to remain above the central bank's 2% target until the second quarter of 2027, highlighting persistent price pressures despite years of elevated interest rates. Persistent inflation persistence is my central case, Mann said, suggesting inflation could remain elevated longer than the baseline forecast indicates. Mann cited research showing UK households' inflation expectations are particularly sensitive to food price changes, with expectations rising approximately 1 percentage points more following food price increases than decreases. Wage growth also remains elevated, with a notable emerging gap between model projections and observed wage growth, suggesting unexplained strength that could indicate further persistence, she said. Elsewhere, German inflation rose to 2.1% in August, the Federal Statistics Office said on Friday, confirming preliminary data. German consumer prices, harmonised to compare with other EU countries, have risen by 1.8% year-on-year in July. Similar data from France and Spain are also confirming that inflation remains largely under control within the Eurozone. The ECB left rates unchanged on Thursday and maintains an upbeat view on growth and inflation, dampening expectations of any further cuts in borrowing costs. Online supermarket and tech firm Ocado fell 19.9% to the bottom of the mid-cap index after its US partner Kroger signaled a potential retreat from investment in automated warehouses. Elsewhere, JTC said that it was in separate talks with private equity firms Warburg and Premier. Shares in the finance services firm hit a record high, up 15.8% to top the mid-cap index. European stocks proved to be a greater diversifier in the first part of the year, significantly outperforming their US counterparts, but US stocks surged throughout the spring and summer months as the major indices reached all-time highs. Meanwhile, European stocks, as measured by the STOXX 600, basically flatlined over the summer. As a result, the STOXX 600 is still up a robust 9.3% year-to-date, but the S&P 500 has returned about 12.3% year-to-date after a slow start. Now, as valuations of US stocks have soared to above average levels, the question is, will European stocks come back into favour? Researchers at Goldman Sachs provided their take in a recent report. Over the next 12 months, Goldman Sachs is forecasting the STOXX 600 to reach 580, which would be about 5% growth. The STOXX 600 is widely considered the most representative benchmark for the movement of European stocks. There's nothing spectacular there, but it's a solid return that could provide good diversification for potentially volatile US markets. Total return, including dividends, is targeted at 8% over the next year. European stocks are still attractive from a valuation standpoint, they say, with an average PE ratio of about 14, roughly half that of the S&P 500. Goldman Sachs research projects the euro to strengthen by about 7% in the next 12 months to 1.25 versus US dollar, and that would create a drag on European companies' earnings as the relative value of their sales in the US declines. Asian stock markets extended their rally on Friday, with technology and chipmaker shares leading gains as investors tracked record highs on Wall Street amid expectations of that Federal Reserve cut next week. Hong Kong and South Korea were the top performers, while Japan's Nikkei 225 reached a fresh record high despite political unrest in the country. South Korea's Kospi index jumped 1.3%, buoyed by SK Hynix, which surged nearly 6% to a record high after announcing the completion of its next-generation high-bandwidth memory, the HBM4, and preparations for mass production. The memory chip aimed at artificial intelligence applications offers double the bandwidth and more than 40% improved power efficiency compared with the predecessor. Hong Kong's Hang Seng Index advanced 1.6%, with Hang Seng Tech Subindex surging nearly 2.5%. Japan's Nikkei 225 climbed over 1%, a fresh record peak, despite political uncertainty following the Prime Minister's resignation. Japan's broader topics gained 0.7%, also hitting fresh record highs. Back in Asia, China's Shanghai Composite edged 0.2% higher, while the Shanghai Shenzhen CSI 300 was largely steady. Both indices saw sharp gains in the previous session. Alibaba stock gained the most in about 2 weeks after the company initiated a series of moves intended to shore up its place in China's AI development boom. The AI commerce leader's shares climbed more than 7% in early Hong Kong trading, tracking an overnight gain in the US. That takes the Chinese company's gain to over 80% this year, a rally driven by aggressive moves to expand into the fledgling field of AI. India's Nifty 50 closed higher for the week, despite India's inflation rising for the first time in 10 months in August 2025, though it's still low enough for the central bank to consider a repo rate cut if economic growth takes a hit due to US tariffs. The ASX 200 in Australia rose 0.7% to 8,864 at the closing bell, with 10 of the 11 sectors in the green. The All Ords added 0.6% to 9,128.7. The financial sector was among the best performers on the ASX, with all the major banks recording gains. Commonwealth Bank added 1.3% to 169.97. Westpac rose 1.4% to $38.48. ANZ firmed 1.1% to $30.19. And National Australia Bank increased 1.2% to $43.54. The materials sector was also in the green, rallying more than 1%. Gold stocks were a standout, with Regis Resources up 6.4% to $5.80, and Bellevue Gold up 7.4% to 97 cents, and Capricorn Metals adding 3.8% to $12.32. That's, of course, after the precious metal extended gains again. BHP added 1.3% to $4.81, while the iron ore price was at $105.90 US. Meanwhile, energy was the only sector in the red following a lower crude oil price. Woodside Energy lost 3.4% to $24.22, and Karoon dropped 2.7% to $1.59.5 apiece. ASX listed BSP Financial, also known as Bank South Pacific, rallied 12.8% to $8.05 after it announced that the Papua New Guinea Prime Minister had assured the bank that it would continue to service and maintain government accounts. Ventia Services rose 5.6% to $5.31 after its contract to maintain City of Sydney's facilities was extended for $100 million over 2 years. Now, managers of the nation's $4.2 trillion in retirement savings have been rapidly scaling back their exposure to foreign currencies amid growing concerns that a rising Australian dollar will hit investment returns, given their huge exposure to global markets. The enormous shifts in currency exposures revealed in data from the prudential regulator could drive up the Australian dollar as superannuation funds increasingly buy more of the local currency to avoid losses associated with the weakening US dollar. In the 3 months to June, industry super funds had increased the proportion of global stocks that are hedged against the declines in foreign currencies to 22.2% from 20.6%. About $871 billion of super assets are invested in stock markets outside Australia, of which $194 billion is hedged. That leaves the remaining 2/3 of the offshore investment pile vulnerable to a rising Aussie dollar. About 70 cents in every $1 of contributions to super funds are being diverted into international markets. Australia's 2-year bond is paying a return of about 3.404% compared to 3.55% for US Treasuries. That helped lift the local currency above 66 US cents and 49 UK pence. Westpac's head of foreign exchange strategy said the Australian dollar was a standout among the world's most traded currencies. Unlike its peer, he said it was not bogged down by huge public debt and political instability like the euro, pound, and yen. We'll see about that. Bitcoin edged higher on Friday, tracking the broader advance in risk-driven markets amid persistent bets that the Federal Reserve will cut interest rates next week. Bitcoin was last at $115,890 US. But gains in crypto, especially Bitcoin, were held back by increasing doubts about the viability of corporate Bitcoin treasuries after top holder Strategy, formerly MicroStrategy, was rejected from inclusion in the SP 500 earlier in the month. While Strategy's common stock vastly outperformed Bitcoin in 2024, this has not been the case so far in 2025. Strategy is trading up about 8.6% year to date, compared to a nearly 24% increase in Bitcoin. The company is the world's largest corporate holder of Bitcoin, with over 600,000 coins in its treasury. Altcoins also had a strong week after several weeks of steep losses. The world number 2 crypto Ether rose 2.3% and was trading up 4.8% across the week, and XRP rose 1.2% and was up 5.4% across the week. So you can see here that we're still in very bubbly territory. The AI boom is continuing to pump markets higher, and yet, of course, the cracks are still there. Yes, the Fed will cut rates, but that's already priced in. And if you stand back and just think about where we are, the risks to the downside are still pretty strong through this part of the year. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.